We've mentioned about how the rise in interest rates has presented a headwind here for the global equity market, but it's really illustrated in this chart to see the magnitude of damage that's been done to the bond market. The Bloomberg Aggregate Index, which is basically the entire bond market, it's really in its worst rut that we've seen since the 1970s. This is reflecting higher inflation and reflecting a Federal Reserve that's much more aggressive. Now, there is some opportunity within fixed income. We would recommend at this point maybe starting to move out in the maturity range a little bit. We've been short duration for many, many quarters, but now with the rise we're seeing in interest rates and our expectation that the economy is not going to be able to avoid a recession, there is some opportunity in maybe those intermediate term bonds, but we're not ready to buy long-term bonds. Long-term bonds have some structural challenges that are going to keep us cautious against them for some time. That is despite the fact that typically long-term bonds do better when an economy turns over. When you look at this chart, this reflects the concern we have about long-term bonds. What you're seeing here is that the Federal Reserve is not only raising interest rates, but they're reducing their balance sheet. They're actually getting rid of some of the bonds that they put on their balance sheet to ease financial conditions in the market. Now they're reducing that. They've reduced their balance sheet by over almost $1 trillion. But at the same time that they've been reducing their balance sheet, the Treasury issuance has gone up by $2.5 trillion. This is a significant demand imbalance in the Treasury market that we think will keep pressure on long-term interest rates. So we're not ready to invest there yet. So from a duration standpoint, stay in that intermediate curve. The other concern we have is from a credit standpoint. When you look at the credit market, the extra reward that you're getting to take on risk in an environment where delinquencies are rising or bankruptcies are skyrocketing is just simply not there. What we've seen in every recession or every economic slowdown is that extra risk or extra yield that you get for that risk, what we call the spread, that tends to blow out, and that's the time that you buy corporate debt. We just don't see that right now. We think there's a big complacency in the corporate debt market, so we're not ready to invest in that quite yet. So when it comes to fixed income, there is opportunity there, but stay in that intermediate part from a maturing standpoint that helps to mitigate interest rate risk. We're not ready for long-term yet because of that supply and demand imbalance, and we're waiting for credit to really reflect what we see from that delinquency and bankruptcy cycle that we expect to see.